But Foued brings us another one. He says, what do you think about SPLG ETF? Never even S-Plug. That's solar power, I think. That tells you how little I know of. Oh, no, Spider Portfolio Large Cap. Okay. Large cap stocks bound to be a slower mover. Decent dividend of 1.5%. That's pretty good. I find the spreads not so good. Do you have material on options on futures like MEs? Okay, so I didn't read the question on the way forward. No, we don't have any data. We don't support any data or have any searches for options on futures, okay? We don't do that. The SPLG ETF here, I'm looking at the large cap ETF here. Again, just liquidity, not too bad. You know, average volume, 3 million. Okay, that's pretty good. Put call open interest ratio is about dead even, a little bit higher on the put side. That's to be expected. Call volume higher than the put volume today. So that's a little bonus. And let's just take a look at the chart here. Yeah, so again, that almost would have come up in our search, wouldn't it, for the married puts Foued? We're above the 20-day moving average. We're about 90% of that upper Bollinger Band there. It's near its 52-week high, of course. And the MACD went positive above the EMA 9, and it's going positive above the divergence line, but it doesn't matter. This is something I do tend to look for again. But again, it's not based on a fundamental push. It is based on technicals, but it's not based on a fundamental push or underlying metrics as far as growth, earnings, things of that nature. It is. That's an errant comment. It's not like that VIX or the SVIX. It's based on the growth of those components in the ETF. So they've been doing well, and they've been showing growth. So after a dip and after a turn in the market, they're starting to come back up as earnings are starting to come in. But as you can see, it's a tight range slow mover. And I think this is why you're looking for. I mean, even in the lowest points of what we're looking at here, you're at 49.5 to 54. That's a pretty tight range. Yeah, you could say it's a 10% move, and I'd agree with that. Argue that it's about 10% move going up here, then a little bit down, then up, then a little bit down, and then up again. So, you know, it's in this 10% range. And I think what you're saying is, look, there's not a lot of chance that I might see a movement above 55 or 56. And I'm probably not going to see anything dip down below 48.5 or maybe 48. So the idea here is what? I don't think the stock's going to hit here, and I don't think it's going to hit here. Foued might be looking at a bull put credit spread or a bear call credit spread, selling at 55, 56, buying a higher strike call, or combining them both to complete the Iron Condor. But he says the spreads are not so good. The market sees this too, Foued, which means this tight trading range, even though I'm still just looking at a 3-month chart, but I don't expect this thing to have a lot of volatility. I don't expect it to move that much, which means the market isn't expecting it to move that much, which means there's not a lot of fear in this thing having wild swings one direction or the other, which means you don't see a lot of premium on those out of the money ranges up at the 55, 56 level or down at the 48 level. You won't see good spread positions. I don't even know if you'll see it on the futures with that, because the volatility of this is low, 11%. I mean, that's below IBM. Below McDonald's in most cases, below Johnson & Johnson, even in the strong days, and maybe even things like Kraft Heinz that you think of market bellwethers. It's hard to find good spread positions with anything in the volatility of that range. This is that trade-off, just like we talked about with the married put a few moments ago. If I have a higher volatility, or stock that has a higher options on the stock, ETF, have a higher implied volatility, well, we're going to have to make that decision of, do I want to go deeper in the money to have that lower expectancy of profit to keep single-digit risks, or do I want to stay in that 10, 15, 17% in the money range that I'd normally prefer, but take on a 12, 13, or 14% risk? That's the trade-off. You've seen us have other presentations on that regarding the married puts and highly volatile stocks. The reverse concept is true. If you're looking at an ETF, index, or security with lower volatility, which also means it'll have lower implied volatility on the options, the same range you'd look for out of the money and probability of a spread of, say, 80% probability above on a bull put, 80% below on a bear call, or 80 or 85% probability between on Iron Condor, your returns are going to be a severe factor less than say an Iron Condor or a bull put credit spread on something like Apple, even with a volatility of around 0.21, 0.22, 0.23, and other stocks as well. Now they come with a higher risk, but that's the trade-off. If you want to get the returns you want, you've got to go to those higher ranges. Let's just stick with the Iron Condor concept. Combination of an out-of-the-money bull put credit spread and bear call credit spread on a position, sort of trying to double dip. And it is, as you can tell, it's a completely neutral strategy. I don't want the stock or the security really to move at all. But then there becomes the double-edged sword. A stock that doesn't move that much that might be primed for a neutral strategy, such as an Iron Condor or maybe a short strangle, the market knows that too. So it's going to have lower volatility. Lower volatility means much lower premiums. The market knows what we know. There's not a big chance of this having a wild fluctuation unless everything goes nuts all at once. Then we probably have bigger concerns than our position on this particular ETF. So that's where it is. And if it's not there, it's not there. But let's go ahead and take a look. We'll start with SPLG. I'm going to keep it shorter term to that September 15th expiration, 14 days out in time. I'm going to use 2.5 to 5 point spread. I'm just going to clear up my drawings here. I'm going to use more results to see what we can get. Ooh, let's go to all results. And it still did it. Okay, so nothing's coming up. Maybe it has to be 5 to 10. Okay. All right, so it's not finding me anything decent that it likes for the background criteria, but it should be pulling up something in all results unless there's literally no activity. Let me check that. Yeah. So part of the default background we have when building condors and spreads, some of these should have been built, but I should have seen, no, I wouldn't have, I'm sorry. To avoid options that are so deep out of the money, even if there's some volume, even there's volume today, we typically don't build positions where the options have a zero bid, which usually implies no activity on the option since its inception in most cases. You know, the 57, the 58 have had no activity since their inception. They're listing a zero bid, a 10-cent ask, and there was no reason price. Now, this one is traded recently, as of today, 5 contracts, but it couldn't build the second level with it. Let's go to October and click the right button there. Yeah, everything above 56 does not have it. I would have expected to see possibly the 54 and the 55 combined with, yeah, I should have seen the ones for October. These should be in the builder because they have activity, not a great probability, but in all results, that should be irrelevant. So let's take a look at the October one with some better premiums here. Let's go to the custom spread tool. Just build a spread for October. Manually, I should say. We're going to use the 54 and the 55, and I think the 52 and the 51. I know we're really close, but that's where the activity is, and dollar strike differences as well. So we are going to sell the 54 call and buy the 55. That's our bear call credit spread. And we're going to sell the 52 put and buy the 51. That's our bull put credit spread. So at midpoint, which you're probably not going to get, but 15 to 25, that's reasonable. That's reasonable. This seems relatively reasonable, and this seems about right. And net credit of 45 cents for a 49-day out trade on a risk of 55 cents. Now, I know you're really close to the strike price, but these are the ones that have shown recent open interest and option volume, Foued. I don't think the probability is going to be that great. The probability between is going to be that spectacular for this particular position. The stock at 53.08 between the upper break even of 51.55, lower break even of 51.55 and the upper break even of 54.45. It's not too bad. It's $1.45 in each direction roughly. It's pretty decent. But again, it's a tight spread, but it does offer a reasonable return. But I can see what you're saying. just because of where the volatility is. Going further out of the money is not going to get you the premium you want. And right now, even in September or in October, there doesn't seem to be any activity on those strikes. The liquidity is so small. And that's probably because the stock, the ETF, does not move that much and has that low volatility. There's not a lot of interest in the premiums. People are playing the SPX dailies, SPY dailies, right? They're playing the Russell 2000, IWM perhaps, that has a little bit more volatility for the premium. More risk? Yes. This looks like a great return even for 49 days. Don't get me wrong. But remember, this is a tough probability. It might be in the 60 to 65% range, where I'd prefer to be in the 80 to 85% range for credit spread or probability between on an Iron Condor. So that's what we're looking at here, but we just weren't seeing those built in the search by symbol because of such little activity Foued on the position. So an older presentation, I really do need to update this one, and we might have recently. I'll take a look at that in a moment. I'm sorry, I'm going to go into webinars here. Older presentation is under options concepts. We touched upon it back in March here on this presentation. What does implied volatility imply? And a really old one, I think I kept it in here. Let me go back and scroll down here for a moment, Foued. Now, so I'm sorry, I'm in the webinar section, the free webinar section. I'm in options concepts, and there it is. Wow, 2014, almost 10 years old. I definitely have to redo this one. There it is. All right. So yeah, implied volatility, the double-edged sword. And then many say you can't trade without knowing implied volatility, and you always want to go for the higher implied volatility for the better premium. Well, not necessarily, okay? Higher implied volatility, as we just showed, or we touched upon, is going to mean higher premiums. But they're also the stocks that tend to fluctuate more against you. The future fear gauge, the implied volatility, the fear of what's coming up and shifts in that particular security or in the market as a whole, that's not what you want for an Iron Condor. And that's what Foued just ran into. We found a stock that doesn't move that much, an ETF, that trades in a tight range, but he mentioned that the spreads are terrible. And of course, for the out of the money ones that have the good probability, you're looking at a 0 bid and a 10% or 10-cent ask, and there's been no open interest and no volume since it's been open on the market. There's no liquidity on the position. There's no guarantee you could even get 5 cents on that. You might get 2. You might get 3, just like we saw with the activity in the October series. But yeah, that's the risk of it, is that 9 times out of 10, if you go in for a full highest implied volatility butterfly or Iron Condor with the highest premium available comparative wise across the market, you're probably only going to have a 50% win ratio or less, because most of those stocks are going to fluctuate beyond the upper and lower break even and cause you headaches trying to manage and adjust those positions. Yeah, you're getting more bang for the buck up front, but you're also getting more headaches later on. Then again, the 3 bears. A little bit too hot with this higher implied volatility for these neutral Iron Condor, Iron Butterfly strategies. Lower volatility that doesn't move. A little bit too cold. Not enough premium. Good probability. Good trading range, but the market sees that and the market knows there's no risk of a fluctuation, so there's no implied volatility, there's no premium, might not be worth your time. So that's kind of where I stand on that one as related to what to look for at Iron Condor screen. What kind of Iron Condors do we show with our defaults? You can use the sample searches here. That's one view where we look at, still want to look for secure positions, index and ETF Iron Condors. Let's look at our default screen here. I think only 2 came up yesterday when I was trading with this. Oh, now it's more than 600 results, of course. Let me up that probability. Let's put that at 80. And I also want a shorter time frame. I think this is looking in October. I want to go to September. All right. Sorry, folks. I'm going to go up to 75, and I'm going to do 2 more things. My net credit is good. Option bid price is greater than 0.10, and my put price. Oh, sell put. I did that first. My apologies. I want these both to be greater than 10 cents. I've got volume and open interest basics in there. Wow. Okay. I'll go just ETFs. Maximum risk less than 5. There we go. So SPX is in there, SPX weekly, QQQ, SOXS, SMH, SPY. What am I looking at? 5.8% returns, so not that great, but the higher probability of 94, 95%. And these are for 14 days mostly. I could lower that down a little bit, Foued. Remember, I started with the sample search of indexes and ETFs. What's a fair trade-off I might consider? I want to go to a little bit higher return, which means I'm going to have to sacrifice some probability. So let me drop this down to 77. Probability between. And I'll drop my individual probability of puts and calls down to 73. I'm going to up my return to greater than 8. Okay, same positions, but a little different. There we go, 11% return for 14 days. That's pretty good, but that's a bull 3 times ETF. Oof. Could move pretty quickly on the small caps. Ultra Pro QQQ is in there. IWM. Usually you get a better premium, but of course, we're looking for that 83, 84% probability between. But that's a good return, 8.5%. SMH, I don't know. The semiconductor ETF haven't been tracking, but that's a good return at 8.8. Oh, oil and gas production, XOP. 85% probability, 9.3% return. Hey, why not? Let's just track these two. I'm going to put it to portfolio. And I'm going to keep it with the short VIX test because it's the same day. I'll filter that out later. And to keep things simple, we'll just do 10 contracts. So there's my different ones. The 140 put, 143, 162, 165 call. And there's our XOP, Iron Condor. And yeah, total net credit of 18 cents. Oh, this didn't record the midpoint. That's fine. It did natural bid and natural asset was only 6.4%. There we go. What was the other one? IWM. So it's 13 and 26 and 23 and 7. $13 and 26, 23 and 7. Okay, that's good. Oh, I don't. Never mind. This is going to be a little bit lower too, but that's okay. We're just going to use the naturals there, and that's the 7.8% return on IWM for 14 days with that 83.6% probability. Yeah. Okay, folks. So, same thing. We'll just kind of track these a little bit with some other examples we've got coming up next week. With the extended week, and I'll have more time to write presentations and follow up with presentations. And we'll get that ball rolling probably on Saturday afternoon or Sunday morning. All right. So again, those are my thoughts, Foued. I know, not really direct thoughts, not really great thoughts, and I can't give direct advice, but that's volatility and the double-edged sword. The market is seeing what you're seeing, that it doesn't move, and you say, hey, this security doesn't move that much at all. Might be a great position for a neutral strategy, Iron Condor, short strangle, maybe an iron butterfly, but then, wait a minute, this doesn't match my return goals. This doesn't match what I want to see. It's because the implied volatility is too low. The market knows that. The market knows it doesn't move that much. There's no real risk or fear of it. You're not seeing the returns that you want. And unfortunately, to answer the other question that I did answer already, but hey, we don't have the futures in there. We just track the optionable stocks, indexes, and ETFs on the U.S. markets.